Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending June 10th, 2022. Appreciate you all tuning in and subscribing to this channel as well as our podcast, InvestTalk. Now, this week I'm going to title the video, Persistent Inflation Brings More Volatility. And that's what it was this week. This was inflation week. And today, particularly, was the inflation figure. And the U.S. Consumer Price Index, the CPI, came in a bit higher than expectations. It was expected to come in roughly flat from last month, 8.26. We came about 8.58. Now, that's the headline number, and that's what you're going to see in all the articles. But underneath the surface, the core, this is less food and energy, and obviously those are the things that are accelerating the most. That actually decelerated a bit to 6.02, the lowest level since January. So that means that, and that's something the Fed focuses on more because food and energy, especially in this market where Russia's cut off, a huge exporter of energy and food stuff and raw commodities being cut off, and that's naturally going to drive those prices higher, and it has. And so the Fed, I actually think this was a decent report from in the minds of the Fed. Because they're going to see this deceleration here. Now, the next week is Fed week, so we're going to get 50 basis point rate hike next week, and then we get another meeting in late July, and that's also expected to be 50 basis points. Now, this was a slight shift in expectation. There's a bit of odds that there'll be a 75 basis point increase in July. I don't really think that's going to happen. But now there's back to 100% increase in September of 50 basis points. Before, it was kind of in between 25, 50. The market wasn't quite pricing in a full 50 basis points in September. Then again, we're still more than 3 months from that September meeting. So that's going to change. That's going to shift based on economic numbers that come in. Now let's touch on some other economic numbers, wholesale inventories. And I think that's what you're seeing here with inflation rolling over a bit. I think it's going to be sticky high, because they're still at 6%, 6.02% core inflation. That's well above what we've seen in going all the way back. We haven't seen these levels really since the 80s. And remember, the fall of the Soviet Union was the late 80s, and that means that's when, remember, Russia is a huge exporter of raw commodities, and so that was, I think, along with globalization, the big drivers of disinflation for 30 years. And we're in a new world where there's more deglobalization, and Russia is now cut off, and that's why I think we're going to see sticky high inflation, and we're going to decelerate from 6%, but it's going to be a slow slog and probably not get back down to the 1-2% level that we've been in for a long period of time. It's probably going to be a higher step change, probably 3 to 4%. And that's what you should probably expect. And that's why you should expect interest rates headed higher, maybe not as quickly as the Fed is talking about it, but certainly over the long run. Now, wholesale inventories, like I said, up 2.56%. This is the issue. You see the warnings with Target and a lot of the retailers, just too much inventory. A lot was on boats, and all these retailers were trying to get product in for the holiday season, and they just over-ordered. I know people within the retail space, and it's just they were flying things over the top because things were sitting on boats, and finally, beginning of this year, that started to unload, and they unclogged a lot of that. But that means there's just too much inventory in the economy, and that's what you're seeing here. Now, consumer sentiment also came out today. Now, the CPI, remember, this is May, but we're in June. The wholesale inventories, that's April, so that's also a little bit old. And then June, this is our June consumer sentiment. So this is pretty live when it comes to leading or lagging or coincidental indicators, and that came in at 50. Which is the lowest level in a long period of time. And obviously, this is basically recessionary levels back into 1980 when inflation was a big problem. So that obviously doesn't bode well for consumer spending, although the consumer is definitely in better shape than they've been in a while. Now, another thing to watch is the unemployment claims. That is also ticking up here, the highest levels since, January. So you're starting to see an uptick, especially in the tech space, a lot of layoffs happening there. So that's something to watch. So that's the economic numbers. Not a whole lot, but certainly a big, impactful number in the CPI report, and that moved markets in a big, big way today. So let's dig into what happened in the markets. And first, I want to touch on volatility. And volatility, we've talked about this being upward trending, and we've had a pullback in volatility, and now a quick little breakout. Now, we're not breaking out to new highs or anything. And what was interesting is, even though we closed near the lows on the indices, volatility did not close on the lows. So is that telling me that the market, maybe has another push higher? I think that's certainly a possibility. And gold had a big day, and let's look at gold volatility. This is very important to understand that. Well, and I'll show you in a minute the big move in gold. And gold volatility was down on the day. You would think, big move, intraday move in gold. I'll just bring up GLD. There's big intraday reversal bar, very bullish reversal here on gold. You would think gold volatility to explode. No, it's trending lower, and trending lower means bullish prices overall. So those were the things that you want to follow in the volatility market to kind of get an underlying understanding of the broader trends. And gold continues to do well, and I think is poised for a breakout here. Here's GDX, also had a bullish reversal today, and I think this is headed much higher. You got sentiment after this big drop, really got washed out, and gold is volatile. It's a volatile space, but when things are trending up and you have an explosion to the upside, it can be quick and sudden. You saw that here. Look at GDX going from 29 to 40 in the span of 2.5 months. So don't be shocked to see the same type of move well above 40 here, especially with inflation kind of persistently high. Now let's look at equities. The NYSE that had a retest, and what was interesting is, we had this rebound into resistance. Let me take some of these off now, since this is kind of moot at this point. But longer term, I do expect kind of a pullback into about 14,000. But it doesn't mean we have to go there right away. If we zoom in here, what was interesting is we did not lose the lows from 2 weeks ago. So until we close below there on a weekly basis, I'm not going to get too bearish on this market overall. But we are in a downtrend, but bear market rallies can be quick and sudden and rip your face off type of things, especially when short covering happens. So, and maybe next week, remember next week is the Fed meeting, and that often creates fireworks as well. So that's going to be interesting to see, not just what they do. We know it's going to be 50 basis points, but what the market reaction will be and what their rhetoric is about future rate hikes. Now the S&P, let's put that up here, SPX. That also had kind of a retest. This is big support here, the 382 retrace from the high. Let me go back, peak or trough to peak. 382 retrace is very common to be a good support level. And so, do we chop here before a move back into 3,500? It would not shock me to see that later in the summer. But in the meantime, kind of choppiness and upside. But next week will be a big tell. If we break below the candle from 2 weeks ago, I think that is a clear indication we're headed to this 3,500 in the S&P. If not, then I could see some near-term bounces into the 4th of July weekend. So that's what I'm seeing here on the S&P. The fact that we did not break on the NYSE or the S&P to the bottom of the candle from 2 weeks ago is a bit of an indicator for me of what's happening. And then look at value to growth. Let's go to a daily chart here. And you saw today, growth got smoked. And if you pull over, if I pull up there you go. Here's the U.S., here's Morningstar, and you can see large cap growth down nearly 5% today, mid cap down 3.5%, small cap growth down 3.2%. And this shows you there's still a lot more carnage in the big tech names. And that's what's interesting here is look, it's not just growth to value. Obviously, growth drastically underperformed value. Large cap value only down 1.8% today, basically outperforming growth by 3% in one day. But in a typical sell-off market, small caps tend to do worse. And on the value side, that's what happened, right? Small caps 2.52, mid caps 2.42, large caps 1.79. That's standard on the value side. But what's happening on the growth side is the opposite. You see that? And that tells you that a lot of the froth has been knocked off of the small cap growth names, but there's still a lot more froth to be knocked out of those large cap growth names. And that was a little nuance that I really wanted to point out today. I thought was very, very interesting. So value continues to outperform, and guess what? This should not shock you. I'm talking about shifting to value, and you need to continue to do that with your portfolios. I did want to touch a bit on the currency market. The yen, another breakdown. I do think we find a low later this month, but maybe it's on the Fed meeting. Maybe the Fed kind of jawbones. They're not going to be quite as aggressive. We'll see. But what's interesting here is it's bucking the trend of the UP, which did have the dollar was up. Remember, these are inverse basically. But remember, this is the UP, which is the dollar index. So you have the euro, you have the yen, you have British pound. Those are the ones that mainly make up the dollar index, along with yuan, etc. But they are weighted based on size. And the euro is the biggest weighting. Japan, I believe, is second, etc. So if you look at FXE, remember the Europe's talking about going to positive rates for the first time, and also reducing their QE recently. So that's a big step change and getting more along the lines with us in the U.S. And that's why you're seeing a little bit of relative strength on the euro versus the yen, which the yen, the Bank of Japan, is keeping it kind of static where it's at with 0% rates. Let's touch a bit on small caps. Another indicator to me that we could see a bounce in this market post-Fed meeting is our small caps. Look at small caps. Small caps to the Dow. Small caps are actually doing well. They held up today in a very, very bloody tape. And so small caps are threatening to actually go in an uptrend, start outperforming. They have been outperforming the past month, but really break out above this 100-day moving average if they can get some traction next week. And so the fact that small caps aren't breaking down compared to the bigger indexes is kind of something I'm taking note of. Let's just say that. Same with here. Look at IWM to the SPY. It's actually above the 100-day moving average. So, if the market was really going to go into some meltdown mode, I would think small caps would be doing worse, and that's not really the case right now. I do want to touch on the 10-year. 10-year up, retesting those highs from earlier last month. But we did not break out to new highs, so definitely something that I'm watching. And the 30-year also did not break out to new highs. So, with the inflation data, everyone worried about inflation. The bond market is not freaking out quite yet, especially those longer term, the longer term treasuries. Now here's SHY. That one did, right? So that one is saying, hey, the Fed is going to get more hawkish. The fact that this tried to turn, right? SHY, remember this is short-term treasuries. So if this goes up, this means that the market is pricing in the Fed having looser policy compared to their rhetoric going forward. And the fact that we had this inflation number is showing a reaction on the short end of the curve that tells you the Fed is going to maintain its hiking policy, aggressive hiking policy. But that's also something I'm seeing if that can hold next week after the Fed meeting. I want to touch a little bit on the sectors and bring up some ratios. I really like these ratios to see, are these trending higher or worse? And this is compared to the S&P. And this is the industrial. So you're starting to see that established higher highs and higher lows. So it shows you kind of want to start to get over weight the industrial space. And naturally you would see basic materials. And I want to back up real quick. And I talked about this on the show. I believe it was Wednesday, maybe it was Monday. And it was really about the sectors that do well in an inflationary environment. And that would be energy and basic materials most of all. And you can see that here is XLB to the SLY. Here's XLE. Here's XLE to the SPY. That one just powering higher. So those are the two ones you want to be most overweight. But still that were positive in an inflationary environment are real estate and real estate and financials and industrials. And so industrials are the ones out of those other three that are really showing that overall uptrend. Now, real estate, that one's doing decent overall, kind of flatlined, which you expect with higher rates to be in a bad place. But actually, real estate IOIR did pretty well today, especially compared to the S&P. So that's something I'm watching. I'm seeing I want to allocate a little bit more to industrials, a little bit more to real estate, along with maintaining overweights in energy and basic materials. XLU, now that typically does not do well in an inflationary environment, but this also continues to be in a nice solid uptrend compared to the S&P. So another area that I'm fine with having at least equal weight, probably a bit overweight on the utility side as well. So that's my assessment of the market today. With how bloody the day was, I saw some cross currents that made me say, I really don't think we're going to break down quite yet. Now, later in the summer, sure, possibility. But with the Fed meeting coming up, I think that's going to be more important. Everyone can read into the inflation number and they're going to come up with their own idea of what that means for Fed policy. But nothing is more important indicator about what future Fed policy will be than Fed rhetoric. And that's what you're going to get in spades next week with the Fed meeting and their decision on Wednesday. So that's really what I want to cover today and this week. And it was a very interesting week. It's filled with a lot of opportunity and obviously risks, and you need to be adjusting your portfolio accordingly in this environment where value is going to continue to outperform growth. I'll remind everybody that the contents of this video are provided for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial and those associated. Appreciate you all tuning in. You have a wonderful weekend.